Alright, let's do a quick and easy example of how to write off a bad debt using the direct write-off method. Citrus Systems has a $5,000 receivable on its books from Aberdam Industries, and this receivable has been on its books for 180 days. So Citrus Systems has deemed this to be uncollectible, and they're going to write it off using the direct write-off method. Well, when you deem a receivable to be uncollectible, you're going to record that amount as a bad debt expense. So that's one of the accounts that's going to be affected. What's the other account that's going to be affected? Well, we got to get this receivable off our books because we can't show it to users of our financial information as an asset, because it really isn't, because we don't expect to ever see the cash from this. So the other account that is going to be affected is the receivable we had on our books from the company that we're considering to be bad debt, in this case Aberdam Industries. What type of accounts? Bad debt expense is an expense, and we know receivables are assets. The amount of bad debt that we're going to record during the period is going up, whereas this receivable is coming off our books. We're decreasing the value of our receivable from Aberdam Industries. Therefore, bad debt expense has to be the debit, and this receivable has to be the credit. So on December 31st, when we write this off, we're simply going to debit bad debt expense and credit our receivable from Aberdam for the $5,000 balance that it had at the time when we wrote off an uncollectible account. What happens later if we receive payment on an account we deemed to be uncollectible in the past? On March 1st, Aberdam is going to actually pay us the $5,000, which it owed us, that we wrote off on December 31st. Well, this is going to be a two-step process. And in the first step, we got to put the receivable back on the books, because we can't record the payment if we don't have the receivable. And we took the receivable off the books on December 31st. So we're going to put it back on by reversing that entry that we just made to write off bad debt. So in this case, our debit is going to be to our receivable from Aberdam Industries, and our credit is going to be to bad debt expense, putting the receivable back on the books and removing the bad debt that we recorded because it wasn't really bad in the long run. So we debit our receivable from Aberdam for the $5,000, and we credit bad debt expense for that same $5,000, and we reverse this previous write-off. Now the receivable is back on the books, we can record collection of payments. So our second step is to record the receipt of cash from Aberdam Industries. And now we get to take the receivable off the books one more time, but this time not because it's bad debt, but because they actually paid it. So our other account is going to be the receivable from Aberdam. They're both assets. Our cash is going up while this receivable is going to go once again down. So we're going to debit cash and we're going to credit our receivable from Aberdam. Debit to cash, credit to the receivable, and we collected payment from Aberdam Industries. Simple as that with a direct write-off method. Once your time period comes to fruition, once 180 days or so have passed and you write it off as bad debt, you write it off right at that period. And if some point in the future you actually receive payment, well, you just reverse the write-off entry you had and then record the receipt of payment like you would the receipt of any receivable.